Fear not, everybody, fear not. This will be actually interesting, short, and entertaining. That's why I keep getting invited. I have no idea why. You keep voting for me. I know nothing about covered bonds. But what I like to do is take a theme that everybody's talking about and take consensus and then skewer it. And I did that last year. Last year, for the people that were in the room, I basically skewered the idea that we were living in interesting and original times. I said we weren't. I said we're at the beginning of a typical cyclical upswing and that economic growth would accelerate and markets in the US would reach an all-time high. And that's where we've got. And I promise over the next 10 minutes, I'm going to pick what I think is one of the most important themes in the market, and apologies that it has nothing to do with covered bonds, and that is the tension between the passive world and the active world. And I will absolutely keep it to 10 minutes because the floor will open. In fact, I once did a TED talk where, I mean, they keep a clock like you never believe. Actually, that was a nightmare now that I remember it. I actually had lots and lots of notes ready for a TED Talk, and I don't know if you know, this was like your worst nightmare. Just before I was about to go on, they said, you know you're not allowed any notes for a TED Talk. I had all my facts, all the data. It's like, ah! Anyway, I will stick to 10 minutes. So this topic, what does this mean? Basically, I'm going to argue that the active industry is overly defensive about its position, and that all the people that suggest that the active industry is in structural decline are probably wrong. And the flip side of that is to argue that passive is not the threat that some people make it out to be. Now, I spent a lot of time trying to make these charts as large as possible. Nothing I hate more than charts you can't read up on a stage at a conference. But I noticed a little bit like Fox News and CNBC, we've so busy putting the logos up that the content bit, the important bit's actually getting smaller and smaller, but I hope you can actually see this. These shows the quarterly net inflows into all asset classes around the world, and the red lines are passive, the blue lines are active, and there is no question that over the last 10, 15 years or so, as you no doubt all know, money has been flowing out of active and into passive in a steady fashion. Now, passive seems to have all the weaponry in this battle with active at the moment. It's very low cost, it's very easy to buy. Warren Buffett loves it. All the academic theory on efficient markets seem to support it. And best of all, the outperformance of the active industry is getting worse. So these blue lines show the percentage of US active funds that are actually outperforming the market, and it's been falling pretty steadily over time. So the passive industry, more or less, has everything going in its direction. That has resulted in total assets rising and rising and rising. The blue bars are the active total funds, the red is the growing proportion of passive, and the black line shows the percentage of money going into passive. So people have been looking at these last few charts and saying, this is only going in one direction. The active industry is in structural decline, the future is passive, and that is clearly the end of the story. Now, it's clear that some of people in the active world are beginning to buy that story themselves and are panicking. So there is a rearguard action emerging. There was a famous Bernstein report from a year and a half or so ago that compared the passive world to communism. The silent road to serfdom, why passive investing is worse than Marxism. Ouch, this paper got a huge amount of press, and I'd encourage you to read it if you like. Ditto in the Journal and the Financial Times, where I used to work, there are more and more articles, unsurprisingly, mostly written by people in the active world. This one was written by a guy who works at Pictet, talking about the hidden dangers of passive. And I did a little bit of a search, and more articles of this nature are occurring. So there is a big push now from the active industry to paint passive as the root of all evil, and they'll have us in gulags in absolutely no time. Now here's a pretty slide for you. I think both sides are misguided, and I think both arguments are wrong. And I think if I can describe to you why they're wrong, both passive and active can live forever in harmony. A, active's not going to disappear, and B, I'm going to show you why passive is no commie threat. Okay, firstly, for me to prove to you that passive is not in a structural uptick, it's quite easy. There's been a lot of work shown that passive has had the most penetration into asset classes where the active guys have underperformed. That makes perfect sense. So on the chart on the left, for example, the blue line shows the alpha generated by active managers falling. The red line shows the penetration of passive rising. But for other asset classes, particularly in fixed income, in emerging markets, global, for example, where the active guys have more or less kept their end of the game up and have outperformed the index, passive has had a much harder time to penetrate. So where the active managers have managed to outperform, passive has struggled. So this fact alone tells me that this is not entirely a structural issue, that there is a cyclical element to it, perhaps. Now, this begs the question, is the difficulty in active managers outperforming structural or cyclical? And it won't be a surprise to you to guess. I think it's cyclical. So what's going on? This green line shows the dispersion in US stock returns, the difference between the best performing stocks and the worst performing stocks. This chart looks the same in Europe, it looks the same in Japan, it looks the same in Asia, it looks the same mostly all around the world. So when active managers and your person running your pension fund complains how hard it is to outperform the index, they're actually right. It has been harder to outperform the index over the last 10 or 15 years or so. The dispersion of the best performing stocks and the worst performing stocks has been falling steadily until recently, where it's beginning to tick up. Why has it done this? If we can say that this dispersion is going to reverse, that dispersion is beginning to widen again, we can put the argument together that the world may be more amenable to an active approach than the passive approach. It all comes down to margins, and the reason why it's been so easy, and the reason why dispersion has fallen, is because it has been easy, even for the most rubbish companies in the world, to generate high cash flows and high margins. My dog could run a company in the last 15 years and have higher margin growth. And what are the reasons for that? Firstly, interest rates have been falling over 20 years, so interest costs have fallen. Tax rates have fallen, and wage growth has been very low. And this has allowed poor companies as well as high-quality companies to generate quite high margin growth. So this chart shows the net interest expense as a proportion of EBIT. It's been falling and falling and falling. Borrowing costs for companies have been falling. But look, that is now ticking up. This chart shows average hourly earnings growth for workers, wages. They're recovering, slower than you would hope, but both in Europe and the UK and in the US, the labor share of output, the labor share of GDP, for the first time in a long time, is beginning to tick up again. So 2 out of the 3 things are making it more difficult for corporates. This is the effective tax rate of US companies. We know the headline rate in the US is high, but the effective tax rate for US companies has been falling over time. They've been putting headquarters in Ireland, they've been funneling costs around the world, they've done lots of trickery to lower their tax rates. I don't think this is possible, again, to such an extent. So 3 out of the 3 things that companies have done, poor quality companies that have done, that have allowed them to have high cash flows and high margins, are now turning. What this has also done, ignore the yellow line, this has allowed companies to pay high dividends because investors have liked yield. So the black line shows the proportion of total returns that comes from capital gains. It's been falling in the US and it's been falling around the world. Companies have preferred to pay shareholders out of dividends rather than capital appreciation. And they've been able to do this because cash flows are high, because margins are high. And it's been very, very easy to do. But for the three reasons I gave before, I think this game is up. And already I think there are a few signals from that. In Europe in particular, there's a big surge in corporates paying dividends, scrip dividends. And this is always a real early warning sign that they're struggling to generate enough cash flows to pay dividends. And here's another chart which tries to show you that this game is also up. This is again a dispersion chart. The black line is the dispersion in dividend yield for corporates. It's been falling. Like I said, every company in the world has been trying to pay you a 3.5% dividend yield, a 2.5% dividend. They've been bending over backwards to do so. We know they've been bending over backwards to do so because the dispersion in their payout ratio, the amount of net profits that they pay out as dividends, has actually been increasing. This tells me that companies are more and more struggling to pay you the dividend that you want. So I see that this is reversing. So what does all this mean? It means we have to reassess what we thought we were saying before. So the rise of the passive industry has not caused lower performance dispersion, it's the other way around. In fact, everybody always says, oh, passive has crushed returns, and that's why dispersion has fallen. Actually, it's the other way around. The growth of passive has nothing to do with lots of clever people coming up with a fantastic new product. It's actually a very, very rational response to the falling dispersion of returns around the world. Why pay squillions for an active manager when dispersions are falling? But if that changes, and I think it will for the reasons that I gave, it suddenly becomes A, clever to move from passive to more smart beta, and if it continues, you'll see a progression from smart beta into active. And the flip side of this is, passive investment obviously doesn't distort the economy. Rather, central bank action, falling interest rates, lower wages, the distortions were already there. The distortions have what caused the passive industry to grow and not the other way around. Now, this leads to the major counter-argument, what you hear a lot in the papers, that passive is evil because it destroys price discovery. There's somehow this argument that because passive has to buy every stock in the index, it's buying the rubbish and it's also buying the quality companies. And this is where the Marxist argument comes in, that somehow it's going to hurt economic growth because the efficient allocation of capital is going to be distorted. I've tried to think of a way of showing that this is complete bunkum. That Bernstein report is wrong. And so I tried to think of a world where there were just three managers, two small active managers, let's call one a hedge fund and one Deutsche Asset Management, and let's say there's a world where there's just one gigantic passive fund with $1 million of AUM and two tiny little active funds. What happens, and let's say they own two stocks, Apple and Caterpillar, what happens when a big inflow goes into the passive fund? Imagine there was one active manager left, and he knew that there was an inflow into the passive fund. The prices of those two stocks would actually go to infinity. It's impossible. It would never actually resolve itself, because I know the passive fund has to buy. I know I'm the only player that can sell to them, so there is no price at which I would sell, because I know the passive fund has to have an index weighting, and the combination of us both are the index. So you can never actually get to the point where there's only one active manager left. So let's say there's two active managers. But even then, the price signal comes in that the passive fund is a buyer. And at that point, the active part of the market has to look at Caterpillar and look at Apple and work out which one it prefers. So the bids come in and the prices go up, and both the two active players go, oh, I think I like Apple. No, oh, no, I like this one more. And they do all their analysis until they reach a price at which they are willing to trade, at the price at which the active managers are willing to trade. And at that price, they can also trade with the passive fund. At no point does the passive fund have any influence on the relative valuation of Apple and Caterpillar? It does not distort price discovery. It does not distort the efficient allocation of capital. Now, in this example, yes, it's caused the market to go up because it's a net new inflow of money. But actually, what's mostly happening is money's going out of active and into passive. So you wouldn't get this big increase in the index. The final thing to say from this, and this is the sort of goes back to the love heart, is that there's a fundamental point about the market that most people fail to understand. The market return is simply the aggregation of all the passive returns and all the active returns. So you work out the very simple mathematics. By identity, if passive has to be equal to the index, then the passive industry will always return the same as the active industry. There will be no difference in aggregate between the returns of active and the returns of passive. So at the end of the day, there need not be this horrendous battle between the two approaches. You may choose one over the other on the basis of cost or ease of use, and that's fine, and that's up to you. But ultimately, what you should think about when you're making the decision between active and passive is where you think dispersions are going to go, and then you can quite cleverly say to yourself, I think in this asset class I'm going to go passive, and in this asset class I'm going to go active. So for those reasons, the conclusions are, active management is not in structural decline, and in my view, the fortunes of the active management industry are actually going to improve over time. Passive is not a threat to the world, so Bernstein and Pictet and others are wrong, and it's illogical to say that active and passive are not complementary or are inconsistent. And there you go, that's 10 minutes. So thank you very much for your attention. Enjoy the rest of the conference.